G'day folks, today we're diving into a topic that's incredibly important for anyone thinking about their golden years. Let's talk about something close to all of our hearts: retirement. It's a phase of life we all look forward to, but it requires careful planning and smart decisions. Specifically, let's talk about self-managed super funds, or SMSFs for short. These are special types of retirement funds that give you more control over your investments. In a nutshell, an SMSF is like a DIY retirement fund. You're the boss. You get to decide where and how your money is invested, much like assembling your own furniture. You call the shots on how your retirement savings are invested. Whether it's stocks, property, or other assets, the choice is yours. Now, why would you want that kind of responsibility? It's a fair question because managing your own super fund isn't for everyone. Well, with great power comes, the potential for a better retirement. If you have the knowledge and the time, an SMSF can be a powerful tool. An SMSF gives you more control and flexibility over your hard-earned money. You can tailor your investment strategy to suit your personal goals and risk tolerance. You get to choose investments that align with your goals and risk appetite. But hold your horses. This isn't something to jump into without careful consideration. Before you dive headfirst into the world of SMSFs, there are a few things you need to know. It's not just about the potential rewards, there are risks involved too. Like any good investment, there are risks as well as rewards. The market can be unpredictable and poor decisions can impact your retirement savings. Understanding both is crucial before you take the plunge. Educate yourself, seek professional advice, and make informed decisions. So, if you're ready to roll up your sleeves and take charge of your retirement future, read on. We'll guide you through the ins and outs of SMSFs. We'll unpack everything you need to know about SMSFs in plain English. From the basics to the more complex aspects, we've got you covered. Remember, the best time to start planning for your retirement was yesterday. The earlier you start, the better prepared you'll be. The second best time, today. So, let's get started on this journey to secure your financial future. So why would you consider an SMSF? Let's talk about the good stuff first, the benefits. Firstly, SMSFs offer unparalleled control over your investments. You're not stuck with a cookie-cutter approach. You get to tailor your investment strategy to match your personal goals and risk tolerance. Want to invest in that up-and-coming tech company or a piece of Aussie farmland? With an SMSF, you can. Secondly, SMSFs can be surprisingly cost-effective, especially as your balance grows. You'll pay fees, of course, but they're usually fixed. This means as your nest egg gets bigger, the fees eat up a smaller chunk of your returns. Thirdly, SMSFs offer potential tax advantages. Superannuation already has a very generous tax structure, and with an SMSF, you can potentially maximize those benefits even further. This is where getting good advice from a financial advisor who specializes in SMSFs can be invaluable. Lastly, SMSFs provide greater transparency. You know exactly where your money is invested and how it's performing. No more blindly trusting someone else to manage your retirement savings. With an SMSF, you're in the driver's seat. Now, before you get too excited, let's take a look at the other side of the coin. While the allure of managing your own self-managed super fund, SMSF, can be strong, it's essential to understand the full scope of what you're getting into. While SMSFs offer amazing flexibility and control, they also come with a significant amount of responsibility. This isn't just a casual hobby, it's a serious financial commitment that requires your full attention. First and foremost, running an SMSF is not a walk in the park. It's akin to running a small business where you are the CEO, CFO, and the entire board of directors all rolled into one. The administrative burden alone can be daunting. It's a legal obligation that requires time, effort, and a good understanding of investment and superannuation laws. You need to be well versed in the legalities to ensure compliance and avoid penalties. You'll need to stay on top of paperwork, reporting deadlines, and ever-changing regulations. Missing a deadline or failing to comply with a regulation can result in severe penalties, which can be both financially and emotionally draining. Secondly, there's the issue of liability. As a trustee of your own SMSF, you're personally liable for the fund's decisions and compliance with regulations. This is a heavy burden to bear, as any mistakes can have serious repercussions. As a trustee, you are responsible for every decision made within the fund. This includes investment choices, compliance with laws, and ensuring that the fund is run for the sole purpose of providing retirement benefits to its members. This means your personal assets could be at risk if things go south. If the fund incurs losses or fails to comply with regulations, you could be held personally accountable, which could jeopardize your financial security. Thirdly, managing investments can be time-consuming and complex. It's not just about picking a few stocks and hoping for the best. You need to have a well-thought-out investment strategy and continuously monitor and adjust your portfolio. You'll need to research investment options, monitor their performance, and make adjustments as needed. This requires a significant amount of time and effort, and if you're not prepared for this level of involvement, it can quickly become overwhelming. If you're not comfortable with this level of involvement, an SMSF might not be the right fit for you. It's important to be honest with yourself about your ability and willingness to take on these responsibilities. Lastly, there's a cost involved in setting up and running an SMSF. While the ongoing costs can be lower than retail or industry funds, especially as your balance grows, the initial setup costs and ongoing administrative requirements can be significant. It's not just about the money you'll need to invest. It's also about the time and effort required to manage the fund. You'll need to consider accounting fees, audit fees, and other administrative costs that can add up over time. It's crucial to weigh these costs against the potential benefits before making a decision. An SMSF can offer great rewards, but it's not without its challenges. Make sure you're fully prepared to take on the responsibilities that come with the territory. All right, so you've weighed the pros and cons and decided that an SMSF is the right choice for you. This is a significant decision, and it means you're ready to take control of your retirement savings. It's a big responsibility, but with the right steps, you can manage it effectively. Good on you. Now let's walk through the steps involved in setting up your own fund. It's a process that requires careful planning and attention to detail. But don't worry, we'll guide you through each step. Firstly, you need to choose your trustees. Trustees are the individuals responsible for making decisions about the fund and ensuring it complies with all legal requirements. An SMSF can have up to 4 members, and each member must also be a trustee. This means that everyone involved has a say in how the fund is managed, and everyone shares the responsibility. This means you're directly responsible for managing the fund and complying with all the rules. It's a role that requires diligence and a good understanding of the regulations. You can also choose to have a corporate trustee, which means setting up a company to act as the trustee. This option can provide additional flexibility and may simplify some administrative tasks. This can offer some administrative and legal advantages. For instance, it can make it easier to add or remove members and can provide a level of separation between the fund's assets and the personal assets of the members. Secondly, you need to create a trust deed. This is a crucial document that sets out the rules for how your SMSF will operate. This legally binding document outlines the rules of your SMSF, including how contributions are made, how benefits are paid out, and how the fund is to be wound up. It's essential to ensure that your trust deed is comprehensive and complies with all legal requirements. It's like the rulebook for your SMSF, so it's crucial to get it right. Any mistakes or omissions can lead to significant issues down the line, so it's worth taking the time to get professional advice when drafting your trust deed. Thirdly, you need to register your fund with the ATO. This is a mandatory step to ensure your SMSF is recognized and can operate legally. This step is crucial to ensure you're eligible for the tax concessions available to SMSFs. These concessions can provide significant tax savings, making it an essential part of the setup process. Once registered, you'll receive a trust ABN and TFN, which you'll need for all your fund's dealings. These numbers are essential for managing your fund's tax obligations and for identifying your SMSF in all official transactions. Finally, you need to open a bank account in the name of your SMSF. This account will be used to manage all the financial transactions of the fund. This is where you'll deposit contributions, receive investment income, and pay expenses. It's important to keep accurate records of all transactions to ensure compliance with legal requirements. It's important to keep your SMSF's money separate from your personal finances at all times. Mixing personal and SMSF funds can lead to compliance issues and potential penalties, so always maintain clear boundaries between the two. Now that your SMSF is up and running, It's time to think about the fun part, investing. But before you start picking stocks or property, you need to develop a solid investment strategy. Think of your investment strategy as your roadmap to retirement. It outlines your investment goals, your risk tolerance, and how you plan to allocate your assets to achieve your desired outcome. It's essential to create a strategy that aligns with your personal circumstances, time horizon, and financial goals. When developing your investment strategy, it's crucial to consider diversification. This means spreading your investments across different asset classes, such as shares, property, bonds, and cash. Diversification helps to manage risk and protect your nest egg from market volatility. Remember, your investment strategy isn't set in stone. It's a living document that should be reviewed and updated regularly to reflect changes in your circumstances, market conditions, and legislation. Regular reviews help to ensure your investments remain aligned with your goals and risk tolerance.